$66 billion just landed in the accounts of the wealthiest agricultural operations in the United States. That sounds like it should save American farming, and that's what Congress told everyone it would do. But here's what nobody is talking about. The money to pay for it came directly out of the food assistance budget that feeds 42 million low-income Americans, and the bill that delivered it permanently destroyed the 60-year political alliance that held farm policy together. Two pieces of legislation, signed into law 8 months apart, have rewritten every rule governing American agriculture, and the fallout will reshape the rural economy, the food supply chain, and grocery prices nationwide for the next decade. A system built on compromise. For decades, the Farm Bill ran on a political bargain that nobody dared to break. Rural lawmakers who needed subsidies for commodity producers cut a deal with urban lawmakers who needed SNAP funding, the Supplemental Nutrition Assistance Program. Farm subsidies and food assistance moved through Congress together, locked inside one enormous omnibus bill that both sides accepted or neither side got anything. That alliance, called the urban-rural log roll, is the reason the Farm Bill passed on schedule every 5 years from the 1990s through 2018 without a single failure. $428 billion over 5 years. That was the price tag of the 2018 Farm Bill. SNAP consumed roughly 80% of that total. Farm commodity support and crop insurance combined for about 13%. And conservation programs picked up 6%. The ratio told you everything about the political math. Food assistance bankrolled the entire package, and without urban votes, farm subsidies would never survive a floor vote. That 2018 act expired in 2023, and what followed was paralysis. Deep partisan splits, baseline funding battles, and cascading economic crises froze Congress in place. Lawmakers punted with one-year continuing resolutions to keep the framework alive while the agricultural economy crumbled around them. Between 2020 and 2025, the sector absorbed a global pandemic, historic supply chain chaos, runaway inflation, and aggressively tightening monetary policy that pushed borrowing costs through the roof. Diesel prices spiked, synthetic fertilizer costs ballooned, machinery became unaffordable, and labor grew scarce. Crop prices briefly surged during the pandemic era, and that brief window of profitability vanished into a steep structural decline that wiped out more than 175,000 individual farming operations since 2017. By late 2025, the safety net sat hopelessly outdated, delivering a mere $2 billion in commodity program support for the 2024 crop year, nowhere near enough to stabilize a multi-hundred-billion-dollar industry. The reconciliation shock. Serious. Standard Farm Bill negotiations required bipartisan votes, and those votes did not exist, which meant the legislative majority turned to an alternative path called budget reconciliation, a parliamentary mechanism that sidesteps the Senate filibuster and passes sweeping fiscal legislation on a simple majority. On July 4, 2025, President Donald Trump signed the One Big Beautiful Bill Act into law. Most of the public coverage focused on its permanent extension of individual tax rate cuts, altered deductions for state and local taxes, and new tax exemptions for tips and overtime. What drew far less attention was the agricultural and nutritional overhaul buried inside the same bill. Reconciliation rules permit the manipulation of mandatory spending programs, and the agriculture committees exploited that opening to bypass the deadlocked Farm Bill negotiations entirely. Tens of billions flowed into commodity supports, and the budgetary offsets to pay for them came from gutting the domestic nutritional safety net. That single maneuver shattered the urban-rural log roll, permanently. Rural agribusiness interests locked in their commodity enhancements and crop insurance expansions through a partisan tax vehicle, which meant they no longer needed urban lawmakers at all. The bill executed two contradictory fiscal actions at once: a massive expansion of agricultural subsidies for corporate producers and an unprecedented devolution of food assistance costs onto the states. The base acre caste system, $66 billion over 10 years, poured into the agricultural commodity sector through the OBBBA. Agriculture risk coverage, price loss coverage, and dairy margin coverage all received extensions through the 2031 crop year. and statutory reference prices jumped dramatically. Corn climbed from $3.70 to $4.10 per bushel, soybeans from $8.40 to $10, wheat from $5.50 to $6.35, and peanuts surged from $535 to $630 per ton. None of that money landed evenly, and the reason traces back to a policy mechanism called base acres. Base acres represent a historical snapshot of what crops a particular farm planted, often based on decisions made decades ago, and federal commodity payments are distributed according to that historical record, regardless of what the farmer actually grows today. A southern producer can plant profitable soybeans or corn while simultaneously collecting artificially inflated federal subsidy checks tied to a historical peanut or cotton base, which meant the system rewarded geography and legacy over actual production. Congressional Budget Office projections lay the disparity bare. $279.99 per acre through 2031. That is what a peanut base acre commands in potential federal outlays. Rice base acres receive $233.44. Seed cotton pulls $118.52. Midwestern corn base acres get $39.14. Wheat collects $32.86. Soybeans land at a mere $19.08 per acre. The gap between the highest paid and lowest paid base acre stretches to more than $260, and by widening that chasm, the OBBBA funneled the bulk of its $66 billion agricultural infusion toward large-scale southern commodity producers and consolidated agribusiness conglomerates. The SNAP devolution, commodity producers collected the windfall, and the Americans who depend on federal food assistance absorb the cost. SNAP had always operated as a uniquely federalized entitlement, 100% of actual food benefits funded by Washington, administrative costs split 50-50 with the states. None of that survived the OBBBA. Starting in October 2026, states must cover 75% of all SNAP administrative costs, a sudden 25% increase in their financial liability. By fiscal year 2028, the legislation forces states to start paying a percentage of the actual food benefits their citizens receive. Any state whose payment error rate exceeds 6% must cover at least 5% of total SNAP benefit costs, and that penalty scales all the way to 15%, which matters enormously because every federal SNAP dollar generates up to $1.80 in local economic activity during downturns, flowing directly through grocery stores, food retailers, and agricultural supply chains. Food-insecure families already spend 20% more on health care annually, loading roughly $53 billion onto the medical system. $15 billion in new annual obligations, that is the projected burden once full phase-in arrives. National Governors Association estimates peg the average state increase at $218 million per year. Ohio alone expects to lose $47 million annually from the administrative cost shift. Maryland faces an estimated $58 million in administrative costs, with an unmitigated error rate penalty potentially stacking an additional $240 million yearly in direct benefit costs on top of that. Even Utah, which runs one of the leanest SNAP programs in the country, projects that a 0.26% bump in the state error rate triggers a $20 million annual penalty. State governments operate under strict constitutional balanced budget requirements, which means they cannot borrow their way out of this. Every state legislature faces the same zero-sum triage: aggressively restrict SNAP eligibility, raise property and sales taxes, or strip funding from public schools, infrastructure, and emergency response. Compounding the damage, the OBBBA expanded work requirements, mandating that adults up to age 64 work at least 80 hours per month to maintain benefits, and removed previous exemptions for veterans, the homeless, and youth aging out of foster care. $65 billion in costs pushed onto state and county governments over the next decade, all to offset the budgetary scoring of corporate tax cuts and commodity subsidies. And the federal commitment to uniform national food security effectively ceased to exist. The Farm, Food, and National Security Act, after the OBBBA reshaped the most expensive titles, The House Agriculture Committee drafted separate legislation to handle the remaining orphaned provisions from the expired 2018 Farm Bill. Committee Chairman Glenn Thompson released the 802-page Farm, Food, and National Security Act on February 13, 2026, and following a marathon 25-hour markup from March 3rd through March 5th, the committee advanced it on a vote of 34 to 17. What makes the FFNSA different from every previous Farm Bill draft is the ideological lens. The legislation frames the domestic food system as critical national security infrastructure, a sharp departure from the historical approach. Heightened oversight of agricultural land protects against foreign influence by codifying GAO recommendations to amend the Agricultural Foreign Investment Disclosure Act, requiring real-time data sharing on foreign land purchases, establishing shell entity identification protocols, and building a centralized federal apparatus to track foreign market penetration in rural real estate. Centers of Excellence for Agricultural Cybersecurity at universities would protect genomic data, precision farming networks, and supply chain logistics from state-sponsored cyber attacks. The bill also suspends permanent law through calendar year 2031, which neutralizes the legislative mechanism that traditionally forces bipartisan reauthorization by threatening reversion to obsolete parity pricing formulas dating back to the 1938 and 1949 Farm Bills. The Preemption Wars. Federal preemption of state regulatory authority drives the most heated legal and economic battles inside the FFNSA. California voters overwhelmingly passed Proposition 12 in 2018, mandating minimum space requirements for breeding pigs, veal calves, and egg-laying hens, and the law barred the sale of any products within California that failed to meet those standards, no matter where the animal was raised. The Supreme Court upheld its constitutionality. 12% of small pork operations either exited the market or abandoned breeding in the first quarter of 2025 because the capital costs of retrofitting their facilities proved insurmountable. The Ending Agricultural Trade Suppression Act, embedded inside the FFNSA, expressly blocks states from enforcing breeding and raising standards for livestock produced outside their borders, which guts Proposition 12 and Massachusetts Question 3 simultaneously. National Pork Producers Council leadership celebrates the provision as restoring regulatory certainty. But here's the thing. Independent Midwestern hog farmers who sank massive private capital into Proposition 12 compliance see the opposite. Federal preemption destroys the premium market they built to survive. And organizations like Farm Action argue that Washington is picking winners and losers, stranding the capital assets of independent early adapters to shield the profit margins of consolidated corporate meat packers. Running parallel to the animal welfare fight, the FFNSA rolls out sweeping pesticide labeling preemption. Multinational agrochemical manufacturers spent the past decade absorbing billions in state-level tort liability from failure to warn claims linked to glyphosate and paraquat. The 2026 Farm Bill shields those manufacturers by legally prohibiting states from establishing pesticide health warning labels that exceed federal EPA standards, which insulates the companies from state-level litigation entirely. The insurance overhaul. Headlines fixate on the policy battles, but the single most expensive structural transformation is unfolding inside America's crop insurance system. Premium subsidies for the supplemental coverage option and enhanced coverage option jumped from 65% to 80% under the OBBBA. Decoupling. SCO from Title I programs lets producers simultaneously enroll in agriculture risk coverage at the Farm Service Agency and purchase SCO through their crop insurance agent, stacking heavily subsidized coverage layers that previously were mutually exclusive. Whole Farm Revenue Protection expanded its maximum coverage from 85% to 90%. February's price discovery period sent unmistakable signals across the sector. Spring projected insurance prices landed at $4.62 per bushel for corn, $11.09 for soybeans, and $6.19 for spring wheat, with corn volatility factors dropping to 0.15, the lowest reading in 15 years. Lower volatility means cheaper premiums on paper, but the revenue guarantees those premiums buy sit drastically below the costs of actually growing the crop. An 85% coverage policy locks corn at $3.93 against a $5 break-even, soybeans at $9.43 against $12.27, and spring wheat at $5.26 against $7.96. Baseline individual policies alone cannot secure operating loans from agricultural lenders anymore, which triggered a historic acreage pivot. USDA projects corn plantings contracting by 4.8 million acres, dropping from 98.8 million down to 94 million, while soybean acreage expands by 3.8 million, from 81.2 million to 85 million. That 8.6 million acre swing traces directly to the soybean to corn price ratio, landing at 2.40, a threshold that consistently triggers aggressive switching. Corn devours capital, requiring expensive upfront nitrogen applications. And in a world of tight margins and elevated interest rates, soybeans present a dramatically lower variable cost profile. Domestic soybean crush capacity is expanding fast, fueled by renewable diesel and sustainable aviation fuel mandates, with domestic crush projected to reach a record 2.655 billion bushels. The fiscal reckoning, serious. $1.4 trillion over the next decade. That is the Congressional Budget Office's projection for mandatory farm and nutrition program spending. SNAP still claims the largest share at roughly $1 trillion, though the figure drops significantly from previous baselines because of the $15 billion annual state cost shift and expanded work requirements. Commodity support programs absorb about $200 billion. Federal crop insurance takes $192 billion, inflated by more than $23 billion from the new subsidy enhancements alone. Conservation programs receive approximately $60 billion, roughly $1 billion of which was stripped from the Environmental Quality Incentives Program and redirected elsewhere. Zooming out to the full OBBBA, the deficit impact stretches to between $3.4 and $3.94 trillion over 10 years. Federal deficits for 2026 sit at $1.9 trillion, with projections averaging $2.4 trillion annually through 2036. Pushing the national debt past 120% of GDP. A permanently codified 23% pass-through business income deduction costs $820 billion over the decade, and nearly 70% of all pass-through income flows to the top 1%. Distributional analyses reveal the legislation reduces income for the poorest 20% of Americans by an average of 3.8%, while boosting the wealthiest 20% by 3.7%. A 7.5 percentage point gap. Running in parallel, the top 10% of farm operations routinely capture over 2/3 of all federal agricultural subsidies, and just 6,000 peanut, cotton, and rice farmers in the southern states stand to collect the lion's share of the reference price windfalls. $3.31 for every dollar that actually reaches a farmer. That is the long-term cost ratio of the federal crop insurance program, which now covers 543 million insured acres across 89% of the acreage of the 8 major field crops, representing a $192 billion liability exposure. In 2022, the government handed private insurance companies roughly $3.7 billion just for delivering the program, $2.2 billion in administrative subsidies, and participating companies posted annual returns of 16.8% on retained premiums, far above the 10.2% that constitutes a reasonable market-based rate. What comes next? $594 billion in total farm debt now, a 5% climb driven by the reliance on operating credit to cover elevated input costs while crop receipts shrink. 93% of lending institutions expect farm debt to increase further in 2026. Roughly half of all row crop producers are projected to show profitability this year, and the other half will not. Bankruptcies jumped 46% in 2025. 5.6% of the farm loan portfolio in the Chicago Federal Reserve District carried major or severe repayment problems by the fourth quarter of 2025, the worst reading since the second quarter of 2020, and working capital is forecast to contract another 9.2% this year. What the 2026 reset built is not a bipartisan safety net. It is a mechanism of federal supremacy, national security infrastructure, and corporate wealth redistribution. Base acre disparities mean a farmer's survival depends on where those crops happen to sit and what commodity the family historically planted, rather than on how well they actually grow food. Devolution of food assistance means the nutritional resilience of everyday Americans is no longer a unified federal guarantee, but a fragmented patchwork dependent entirely on the fiscal solvency and political priorities of individual state legislatures. And restructuring crop insurance into a heavily subsidized income transfer mechanism severs the connection between what a producer pays in premiums and what the actual risk costs, which encourages crop production on marginal lands that free market economics would otherwise abandon. None of this architecture resolves its own contradictions. A system that spends $3.31 in taxpayer money for every dollar that reaches a farmer, that strips $15 billion annually from the food budgets of the nation's most vulnerable citizens to fund $280 per acre for peanut operations. And that drives the national debt past 120% of GDP to sustain itself, is not a safety net. It is a transfer mechanism, and the question stopped being whether these contradictions will surface. The question is when.